trampa. Mientras tanto, hacemos ese análisis internacional, con la mirada puesta en el techo de deuda, con la mirada puesta en Nvidia, que hoy ha recuperado, ha alcanzado el billón de dólares de capitalización, entrando en ese selecto club. Tenemos ya a Edward Moya, que es Chief Market Strategist en Marketpulse y Oanda. Edward, thank you so much for being in Negocios Televisión. Good afternoon.
Oh, it's a pleasure. Thank you for having me.
Edward, everybody is waiting for tomorrow for Congress to approve the debt ceiling deal. Do you think this might be the theory of buy the rumor, sell the news?
Well, I think we're seeing already a major reaction in the markets. When we take a look at the June month for T-bills, yields have come back down to some more normal levels, and it seems there is a lot of optimism. So you're starting to see that reaction already. I think there still should be some caution going into this as far as we still have the House Rules Committee vote. Hopefully that gets pushed forward, it moves forward and advances and paves way for the House to approve tomorrow. But I think you are seeing a lot of investors that are positioned for a rather aggressive defensive posture, I think, going forward. We still have a resilient economy. We still have inflation that is probably going to still be troubling. The labor market is still strong. We're still anticipating strong job growth. So I think more Fed tightening is something that this market has not really properly priced in. So I think you're probably going to see that people might say it's a sell the news type reaction, but I think they're looking at inflation, they're looking at the economy, and they're saying we might see more rate hikes, and that's probably why you're going to see more I think nervousness probably going forward once we're beyond this debt deal.
There are estimates, Edward, that the U.S. will have to issue around $1 trillion in debt until the end of the third quarter this year. But without the Fed buying that debt, do you think that the market will be able to absorb all this debt, or will the Fed need to do some kind of comeback this year in order to buy the debt that the United States has to issue?
Well, I think $1 trillion is, and they're probably going to need to get a lot of that over the next few months. So the money markets will absorb a lot of that, but we have to take note that this is roughly 5 times the pace that we saw before the pandemic. So that's a lot of issuance. So I think you're going to see this is going to put further strain on the economy. You're going to probably see yields really, I think, I think they're going to rally. I think they're going to go higher, and that's probably why I think these Fed rate cut bets for next year, or possibly at the end of the year, are going to become more stronger calls. The Fed is going to probably have to step in because there's just not enough buyers, I think. So I think that's another important thing to keep on your radar.
Stock market now, Edward, resembles to that stock market of the old days before 2022. Do you think that bearish nightmare is already over for the stock market?
I think we're going to see the focus on earnings. It's going to be really about earnings. I think there's, if we did not have this AI enthusiasm over the last, several weeks, you probably would have seen a much lower stock market. But I think it's all going to come down to earnings. And if I think the expectations is for like -1%, but if we see some better than expected earnings going forward, then the stock market rally can continue. I think so many investors are still pessimistic. There's still a lot of money on the sidelines. So when the market is kind of the way it's positioned right now, if there is some bullish catalysts, that could allow us to extend a little bit higher. So we might not necessarily see that significant sell-off that I think a lot of people are anticipating.
Edward Moya, Market Strategist at Oanda, thank you so much for being in Negocios Televisión as always.
Thank you.
Bueno, y nosotros mientras tanto nos fijamos en